That's amazing. Yeah, I'd love to hear about, how you avoid the tick model, right? Because we did take some 1031 funds into the TIC, tenants in common arrangement, and there was it was a little bit extra headache, right? There was like all this extra paperwork that we had to, develop from scratch with attorneys that are, $500 an hour. And that's why we've kind of said, oh geez, we might not want to do that unless we can accept, a larger amount of money, maybe $1 million or $2 million from a single investor that wants to do the 1031. So
what's the biggest frustration when it comes to capital gains tax, the 1031 exchange, and raising or attracting capital for your funds or your syndications when it maybe is not eligible?
I think one thing that a lot of people, don't understand or don't really dig into is with capital gains, we have two assets, right? There's the real estate, which is, collecting lot rent income on that. And then we have the mobile homes. And in some cases, we will buy mobile homes, bring them in and, put them on the lot and then sell them. So in some cases, we will have capital gains tax on the sale of those homes, which is the personal property. And then, obviously when we sell the real estate, that's the other thing. So we just have to make sure we're accounting for that in the first place. A lot of people don't know that you have to pay that on both. And then also I would say with the 1031 model, we haven't done that where we've exited out of a project and, given the opportunity to those investors to reinvest into another deal. So yeah, I can't really speak to that yet, Brett.
Okay, well, this is a great time to be planning, by the way, because guess what? One of the biggest frustrations is a lot of the syndication groups before they work with us, if they go to exit, they've done the cost segs, they depreciate it, right? They maybe, and they don't have a lot of basis left, but it's time to harvest, right? And now they're looking at this huge capital gains tax, and it's somewhere between about 25 to 50% of their gain is going to be wiped out. And this is where we come in and we structure a plan for each partner or just the GPs. And just a couple examples real fast. We did a $13 million exit, Andrew, for 3 clients who built a car wash. Used to be an old taco stand in San Diego, and it was a couple acres, and they bought the land and they rolled the taco stand inside of the car wash and they sold it for $13 million. So they had about a 40% tax on their gain, and we were able to defer the tax, diversify the wealth, pay off their debt. But the best part is they've gone into syndications. They diversified, which is a lot of people, they get to the point, kind of what you talked about, they get tired of the operations, they get tired of running it themselves. They just get tired. They're ready for a new season of life, yet they want to stay in the game in the sense that this is where they know, like, and trust. And so we actually did a 5-park mobile home park exit for Gary Lester, who was the W-2 guy. And he started to buy, went to a seminar on the side, started to buy the mobile home parks, right? And he started to buy 1, 2, he got to 5. He sold it for $10 million, all 5 parks. He had huge tax. He deferred all that tax, and now he's diversified passively into different real estate syndications and funds. And this is the beauty of what we offer. It's called a deferred sales trust. You can learn more about it by going to capitalgainstaxsolutions.com. But I'm curious, Andrew, when you hear that, like, what is that music to the ears for someone like yourself who may have, high net worth individuals that are coming out of crypto, businesses, real estate, mobile home parks, that they could just turn around all tax deferred and invest right back with you?
That's amazing. Yeah, I'd love to hear about, how you avoid the tick model, right? Because we did take some 1031 funds into the TIC, tenants in common arrangement. And there was it was a little bit extra headache, right? There was like all this extra paperwork that we had to, develop from scratch with attorneys that are, $500 an hour. And, that's why we've kind of said, oh, geez, we might not want to do that unless we can accept, a larger amount of money, maybe $1 million or $2 million from a single investor that wants to do the 1031. So how does this deferred sales trust, help us avoid that?
Yeah, so the biggest thing with the tick model is you're in what's called the blockbuster 1031 lane, right? Where you have to do the like kind, 45-day identification, 180-day close. Everything has to line up. And you've got to make this exception inside of your syndication for this little square, peg to fit, perfectly, right? And it is. It's expensive. It's consuming. It kind of messes with your flow. The neat part of the deferred sales trust, because it's not a 1031 exchange, it comes in like a passive investor, like an LLC would. It's an accredited investor. And it simply is a way for you to just not have to change any of your workflow and to be able to keep capital flowing in. And so, for example, we work with some of the top syndication groups across the country, like a Brian Burke, a DLP Capital. We work with Dan Hanford with multifamily housing. We work with Kevin Bupp, which you might know of. And essentially what happens is when this trust closes, because it's not a 1031, it goes in like any other investor would, but it's sort of like an IRA or a 401k in the sense of a self-directed IRA, that it comes in seamlessly. It doesn't affect that. And so there's a part inside of every syndication, the Reg D regulations talks about any entity of which all of its accredited investors or all of its owners are accredited investors. And so that's what changes the game here. You don't have to do a tick ever again. You don't have to have the like-kind replacement requirement. It can be exiting crypto, businesses, primary homes, stock. We can even save a failed 1031 exchange without having to identify the trust. And that to us is the game changer. That's why we call it the Netflix way of exit planning. And if people want to learn more, you can go to Building a Capital Gains Tax Exit Plan. You can go to Amazon to order the book, Building a Capital Gains Tax Exit Plan, hit #1 bestseller. And we have people like Kevin Harrington from Shark Tank in the book, who even he was learning about this for the first time. Go to capitalgainstaxsolutions.com or check that on Amazon.